Now, joining me for the next hour is JPMorgan Chase's Chief U.S. Equity Strategist, Tom Lee. Tom, always good to have you joining us in person. And what do you think of Ackerman's comments? You agree?
I think that investors are making a lot of comparisons to '08, and I think certain markets, I think CDS markets are really similar to '08 highs. But I think there's some major differences too. If you think about in '08, Lehman Brothers was coming at a time when housing was already collapsing. We had a surge in oil, two things that would have already caused a recession. And we didn't have the sort of liquidity of last resort mechanisms that we have today, that would protect the bank system. So Lehman was essentially a crisis that precipitated the creation of a lot of new mechanisms. And
what do you mean, like TARP?
Well, TARP and like the TARP and the TALF and a lot of facilities and new expansions by the Fed.
Okay.
But
we did have that. That's what stabilized us after 2008.
Well, that's right. But that's right. But in the fall of '08, those weren't there.
Okay.
Yeah.
Got it.
So I think today we are looking at a crisis. I think the epicenter really is a lot more about sovereign credit and lender of last resort to sovereigns, right? Especially in peripheral Europe. But I don't think all markets are showing the same kind of stress. I know people are talking about sort of interbank stress taking place, and we're seeing bank shares fall. But banks in Europe are actually able to access funding. Right now it is covered bonds, but they're still access funding, in the short-term markets.
You're saying the lending markets haven't frozen is what you're saying,
correct.
Right? Okay.
And then if you look at spreads, which I think are just as important as CDS levels, high-grade spreads to treasuries, even high yield, they're not nearly at the levels we saw in '08. So, I mean, it hasn't turned into '08 yet, but I can sort of see his comments that these are similar to '08. I don't think this is an analogy to '08.
But it seems like the confidence level, though, is, and I get the sense that that's what some people are saying, is that the confidence is not there. It feels like '08, where, every little piece of news would cause the markets to fall hundreds of points here.
Correct.
That's kind of what it feels like. And what's even more scary is that even though you point out that there was TARP created later and TALF and other facilities, we've used them all up. And so what do we have left now if something does turn out to be an '08 situation?
Yeah, I mean, that is a problem. I think there's two things really that are a problem right now. One is this feedback loop you're talking about, which is we've got stress in sovereign credit markets, which is hurting confidence. A U.S. recovery that I don't think has really slipped into recession, but I think it's under pressure. And then you see the feedback loop between the U.S. and Europe in the markets. And you say it hasn't slipped into recession because why? Well, I mean, I'd say that, there's still pretty decent consumer spending growth. Okay. Jobless claims haven't pointed to this yet. I think a lot of people were pointing to the Philly Fed originally as evidence of industrial expansion slipping into recession, but the ISMs don't show that. Okay. And then, the second issue is really that, Europe, the Europe situation has to evolve, right? They either need to move closer to fiscal unity, or they have to dissolve. So, I think there's still stages of this crisis left, and I think that's actually a problem because we just don't know how much worse things will get in markets, or if things have already bottomed. And yet you still have your target at 1475, though, right? Yeah, and I think this really reflects that there's a binomial outcome, right?
There's a what?
It's a binomial outcome, meaning we're either going to have a recession or this is going to resolve itself. But you're saying there is no recession. Correct. You're saying that this is going to get resolved. That's why you've got a 1475. That's right. I mean, I think in some ways, and I think we're going to have to study this more closely, but, in some ways this could be a lot more similar to 97, 98, which was an emerging markets debt crisis at the time. And then we had long-term capital. And the market resolved itself. And how was that any better? It wasn't. It turns out that just from a timeline perspective, it would look like we're in the fall of 98 again, which was a time when the market staged a huge rally in the fourth quarter. So, I think, it's either 98 or 08. I think that's really what I think we have to really start putting into our thought process here rather than this being 08. But 97, 98 was helped in many ways by the IMF, right? Correct. And by other multilateral institutions. They stepped in with funding for some of these countries in Asia that, were laden with debt. And I think the problem this time around is that where is that leadership, right?
the IMF hasn't made all the
Yes.
correct moves, and as Scarlett was talking about, the leaders appear to be actually doing more harm than good in some ways in trying to stabilize the market.
Yeah, it's been disappointing, right? The lack of political leadership. I think markets are doing the right thing, which is they're pressuring political leaders to make the right decisions. I think it's somewhat healthy. It helps the dialogue along, actually, that the market's under stress, because it's going to really force politicians to do the right thing. I do think what we have to remember is Europe has the tools internally to solve its problems, right? Europe doesn't have a huge primary deficit, and they don't have a huge in aggregate debt load. But the problem is the mechanism isn't really in place to sort of step in and fund Greece and Italy if there's problems on an unlimited basis.
Okay. What parts do you like that you've heard so far from any of the candidates, from the president on jobs?
Well,
You got to think a lot about it,
yeah,
right?
I think what resonates actually is the idea that, U.S. corporates are really going to be the big partner to create jobs here, So I really like the idea of, reducing regulation. Sarbanes-Oxley is an example, which has really cost small businesses, millions of dollars a year just to actually be in compliance.
Right, just the accounting rules
Exactly.
itself, yeah.
And, lowering corporate tax rates makes sense. U.S. has second highest tax rates in the world. But I also think it means that there has to be a feeling of partnership between businesses and government, which I think any policies that would result in that, I think would be very helpful. Because right now it does feel like businesses are under attack.
Right, and you've seen some of them fighting back. Howard Schultz trying to get his CEOs to come together and say, let's withhold any lobbying money to politicians until they get the debt in order. But is a market rally, getting back to the markets, is a market rally predicated on a jobs market coming back?
I think it's predicated on a jobs market that isn't going to be as weak as it was in the August report. Something like 70,000 isn't going to be enough to really create an S&P rally, but getting back into the 150,000 range would be sufficient. And I think Europe stabilizing is also important. Europe isn't really getting better. I think Europe's actually worsening, but Europe stabilizing would also be very helpful for an equity rally.
So you need both of those or just one of those?
Well, if you had a booming U.S. economy, then you could overlook Europe. And if you had a weak U.S. but Europe was fixed, you could probably overlook, sluggish U.S. But really, both are acting as negative feedback loops on each other, at least in the minds of investors.
Okay.